The bank looked at your income, your credit score, your debt-to-income ratio, and they said, yes. The realtor showed you a monthly payment, smiled, and said, this is totally within your budget. So, why does that mortgage feel like it's quietly suffocating your finances every single month? Here's what nobody told you before you signed. Mortgage approval does not mean you can afford the house. The lender's job is not to protect your lifestyle. Their job is to lend money they know they'll get back with interest. Whether you have anything left over for groceries, savings, or emergencies is completely your problem. Right now, the average mortgage payment in America is sitting above $2,800 a month. Average. That means millions of homeowners are paying even more than that. And a huge percentage of them are just one job loss or one medical bill away from losing the house entirely. This is the house poor trap. And today, we're going to break down exactly how it works, and more importantly, how to get out of it. The trap doesn't start at closing. It starts with how lenders decide what you qualify for. Banks use something called the debt-to-income ratio. They may approve you for a mortgage that takes up a huge portion of your monthly income. But here's the problem. They calculate it using your gross income. That's before taxes, before health insurance, before retirement contributions. Nobody lives on gross income. You live on what actually hits your bank account. So the bank says you qualify for a $3,200 mortgage, and it feels like a green light. You start looking at bigger homes, better neighborhoods, maybe an extra bedroom. But that number was never meant to protect your lifestyle. It was designed to show the maximum the bank could safely lend. You didn't get a green light. You got the ceiling. And the ceiling is not where you should build your life. Let's look at the numbers, because this is where it gets interesting. Imagine you buy a $450,000 home with 10% down at a 7% mortgage rate. Your monthly payment after taxes, insurance, and PMI could be around $3,300. Over 30 years, you'll pay back far more than you borrowed. A huge portion goes to interest. Now here's what most people never think about. Instead, buy a home you can comfortably afford. Say your total payment is $2,000 a month. That frees up about $1,300 every month. If you invest that $1,300 at an average 10% annual return for 30 years, it could grow to more than $2.9 million. Same income, same starting point, two completely different outcomes. One builds the bank's wealth, the other builds yours. So, how do you buy a house without becoming house poor? Follow the 28-36 rule. It's simple, it's boring, and it works. Keep your total housing costs, including your mortgage, taxes, and insurance, around 28% of your gross monthly income. Keep all your debts combined under 36%. If a lender approves you for more than that, don't see it as a green light. See it as a warning. And one last thing, buy the house you can afford today, not the one you hope you'll afford tomorrow. Don't count on a future raise or future income. Base your decision on today's numbers. That's how you protect your financial future. Here's the bottom line. A house isn't just an investment. It's a monthly commitment. And if you buy more than you can afford, it can control every financial decision you make. Before you buy, use the 28-36 rule. If the numbers don't work, the house doesn't work. And if you're already house poor, look for ways to lower your monthly costs. Whether that's refinancing, cutting expenses, or downsizing, your goal is financial freedom, not financial pressure. If you found this helpful, subscribe to Z Invest. New videos every week on personal finance, investing, and how money really works. Thanks for watching. See you in the next one.